If you're just starting out on your own investing journey, it's easy to become overwhelmed or intimidated by all the information you can find online. You might think that you need to check markets daily, have a deep understanding of financial statements, or be able to pick the next hot stock. But in this video, I want to go through how simple investing can really be and how this simplicity has allowed me to be confident in my own investment strategy and completely manage my own portfolio. Welcome to AFK Wealth, where we talk personal finance over gameplay. So what does it mean to manage your own investments? In practice, there's a wide range of different self-directed investment strategies. Day trading would be considered the most active, and using a target date retirement fund that auto-balances over time would be considered one of the most passive strategies. Before you even start your investing journey though, it's important that you have a solid emergency fund in place and you take care of any high-interest debt that you might have. For a large majority of people, a passive investment strategy can work wonders for their portfolio and peace of mind. The more active a strategy you want to use, the more likely that you're going to be to pay fees which can eat away at your portfolio throughout the years without you even realizing it. For example, if we take two portfolios with a $100,000 starting balance, $5,000 in annual contributions, a 30-year time horizon, and a 7% annual rate of return, we can compare how different fees would affect these portfolios over time. If we use a typical passively managed index fund fee, 0.3%, and compare it to a typical actively managed fund fee, 1%, we can see that the passively managed portfolio pays a total of just over $9,000 in fees over the 30-year time horizon, while the actively managed fund pays out over more than $273,000. Big Finance likes to push the narrative that retail investors need a personal finance person to help them manage their portfolio. And why wouldn't they? The more people that use financial advisors, the more money that they can make from the fees that they charge. Before we get into things, I want to go over some common beginner mistakes regarding investing, and the first one is huge, and that's trying to time the market. If you're trying to time the market, you're going to miss out on some of the most important days of the market. There's many studies that show that time in the market beats trying to time the market. Some other common mistakes that can be detrimental to your journey are constantly switching strategies, chasing hot stocks, checking your portfolio every day, investing money that you're going to need soon, or selling when markets crash. It's important that you're aware of these mistakes so that you can catch yourself before you potentially make them. John Bogle is widely credited with popularizing the passive index fund strategy, and he's the founder of Vanguard, which started in 1975. When he first started promoting the strategy, there was a lot of pushback from the financial industry, and that's due to its hands-off approach. But now it's a very popular strategy, and one that Warren Buffett even recommends for a majority of people. My first introduction to investing was a great book that was actually authored by John Bogle called The Little Book of Common Sense Investing. If you haven't read this book, I would highly recommend it. It's only 270 pages long, and it's packed with a wealth of information that all retail investors should have at their disposal. One of the main takeaways that I got from this book is that over 90% of actively managed funds cannot beat the market over a 20-year time period. When I learned this, it made it impossible for me to justify using an actively managed investing strategy. A powerful quote from John Bogle himself wraps everything into one nice sentence. Don't look for the needle in the haystack, just buy the haystack. Since I started my own investing journey in 2019, I have not once felt like I needed to include a finance professional in my strategy. My strategy is to have a split between U.S. total market index funds, S&P 500 index funds, international index funds, a very small amount of U.S. government-issued I-bonds, and finally, about 3% of my portfolio is made up of speculative, fun, individual stock investments that I make. Having confidence in your investment strategy comes from being educated. Once I understood diversification, compound interest, fees, long-term market history, I stopped second-guessing every market move. Education reduced my anxiety far more than watching my account balance grow, and I did not go to school for finance. If you're willing to educate yourself, spend less than you make, be disciplined over time, then there really isn't a need to pay fees to a financial advisor. It takes away from portfolio growth, and at this point in my own journey, I'm not willing to give those dollars up. Some advantages to managing your own portfolio are that you can make sure you pay the least amount of fees possible. It also helps you build your confidence. With all that being said, I do think that there is an argument to be made that as you get closer to retirement and you have a significant amount of assets, a fiduciary can make sense to help you cover your bases regarding your withdrawal strategy and tax implications. An important distinction to make here is understanding the difference between a financial advisor and a fiduciary. A fiduciary is legally required to act in your best interest, while a financial advisor is not. So when I get to the point in my career where I'm ready to retire from the workforce, I may consult a fiduciary to make sure that I'm not overlooking anything major. Let me know in the comments below. Do you use a financial advisor, fiduciary, or are you completely self-managed like myself? I'd be interested to hear. Another topic I want to briefly discuss is information overload. Especially on YouTube, it seems that every day someone is predicting a market boom or a market crash. There's always a new hot stock and people claiming that AI is going to replace every company. After a while though, you start to realize that nobody really knows what's going to happen in the future. So instead of chasing predictions, I've focused on controlling the controllables. Variables such as your savings rate, investment fees, asset allocation, consistency, these are all things that you can control and that do have a significant impact on moving the needle of your investment portfolio. If you do decide to outsource your retirement strategy to a financial advisor or a fiduciary, this does not relinquish you of responsibility. You need to have a solid understanding of what they're charging you. Are they charging you a flat rate fee or a percentage-based fee? A flat fee is typically always recommended over a percentage-based fee, but for me, I avoid both entirely by controlling my own investments. No matter what route you choose, it's important to make sure that you're contributing early and often. Setting up automatic contributions and investments is how I make sure that I'm always buying into the market on a weekly basis. If this video only convinces one person to start investing instead of waiting another 5 years, then to me, it's worth making. Investing isn't reserved for people with finance degrees. It isn't reserved for millionaires or six-figure earners. Investing is a skill that anybody can learn. If you keep your strategy simple, you'll see that investing is actually quite boring. You contribute money, you buy more shares, and you go live your life. That's it. The excitement comes years later when compound interest starts doing the heavy lifting. If you can understand these concepts, your future self will be incredibly grateful that you started today. One of the most common phrases in personal finance and investing is, the best time to start investing was yesterday, so that means the next best time to start is today. Thank you so much for watching. If you have any questions or if you want me to make a video on a specific topic in the future, please leave a comment down below. I'm trying to build a community of people who are interested in personal finance and video games, so if you like this kind of content, feel free to subscribe. Thank you so much for watching all the way through, and I hope you have a great rest of your day.